Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, December 19th. We're recording at noon Eastern Standard Time. I am your host, Scott Slayton, partner and chief strategist at Capital Creek Partners, and I want to wish all of our listeners a joyful holiday season. So here's your starting lineup. Is it a bubble? ? A fantastic investment memo from Howard Marks. Touch on the key takeaways there. The Australia Strategic Policy Institute releases a report about technologies of the future. Very interesting findings. And third, Micron Technology earnings. This is a company in the sweet spot of the AI boom. So back to number 1. We have long admired Howard Marks as a serious, sober, and skeptical investor who often writes very important memos which all of us can access. I met him in New York City at a party in April, and he looks the part of a formidable investor, very serious man. He makes the case in this memo that we stand at the precipice of a remarkable moment in investing and even human history, that we are now witnessing a transformative technology that is rapidly changing the world. Of course, that's artificial intelligence. But Marx ask the question, does it make sense to invest in artificial intelligence or even to finance it through lending? I thought the most interesting part of his memo was that the historical lesson that railroads, automobiles, aviation, radio, broadband, all of these were economic and society-changing innovations, but all of them at one point or another crushed investors and caused them to lose tremendous amounts of money. The big red flag, according to Marx, is leverage. Hyperscalers have now moved from financing the AI data center buildouts through free cash flow and cash on their balance sheets. They are now tapping the debt markets in size. And we personally are concerned about overspending relative to artificial intelligence. How can these companies earn a respectable return on invested capital on trillions of dollars of spending? It boggles the mind, really. Marx's bottom line here is don't go all in or all out of the AI boom. Much of the AI outcome is just completely unknowable and unquantifiable, so you have to be selective and balance sheet aware. The market certainly is becoming so. Look at what's happening to Oracle. Equity and debt. Look at CoreWeave. Look at even Meta. The market is starting to become skeptical about the size of AI spending. So Howard Marks memos are available online to all. I would encourage all of our listeners to read it. Now, our second thing is an interesting report out of China about the future of technologies. This report was released on December 1st from ASPI, the Australia Strategic Policy Institute, and should have American alarm bells ringing. The scoreboard, according to ASPI, has tilted hard. China now leads in 66 of 74 key technologies. The US leads in 8, and the EU leads in 0. ASPI identified 10 new technologies of the future, where China leads in 8 out of the 10. The report went on to say that China could achieve monopoly power in some very important technologies like cloud and edge computing, computer vision, and grid integration, where they are way ahead of the rest of the world. There are still some positive bright spots for the U.S. The U.S. leads in neuroprosthetics, geoengineering, way ahead of China in those two. But the trend line here matters more than the snapshot. The key point from this report is that U.S. technological dominance of the last 20 years has been eroded by China, steadily eroded over the last 20 years. And to me, this is a compounding story. If you're behind in research, and that's where the U.S. is really falling behind relative to China, you get behind in setting standards, you get behind in attracting talent, and ultimately you get behind in commercializing technology, which has so enriched U.S. shareholders over the last 50 years. So what does it mean for markets? I think it reinforces the importance of getting AI right in the U.S., of getting the electrical grid right. This is where we're really falling behind. And building up these strategic supply chains where I think policy is probably going to have to support for years to come. Technology leadership is now a geopolitical variable. It's not just a Silicon Valley sideshow. It matters to all Americans and all investors. So what are investors to do? Do we invest in Chinese technology through ETFs to avoid being left behind, or to hedge if the US technology companies no longer continue to dominate, or if the world is split into two technology stacks, China and the US? All kinds of reasons you'd want to have some exposure. Also, they're uncorrelated. They're relatively cheap compared to Western technology companies. But shareholders have not been rewarded long-term for investing in China. It's just a different system, and it may not ultimately reward any shareholders. I've certainly never made money in China. And I begin to wonder, will U.S. investors even be allowed to invest there, either by China or by our own government? So a lot of questions. Now on to Micron. Micron reported first quarter 26 earnings of $478 versus a $395 estimate, a solid 20% plus beat, and the stock rallied 10% in response to the quarter and is continuing to rally all the rest of the week. So we decided to dig in, and what we saw here was that revenue, gross margins, earnings, and free cash flow generation all surpassed management guidance by a lot. How does a commodity company have a 57% gross margin? Well, that just tells me they're not a commodity company anymore. And they're beating gross margin estimates on higher prices, cost execution, and favorable mix, according to management. Here's the key takeaway. AI is fundamentally transforming memory from a commodity into a strategic asset. These rapid data center build-outs are sharply increasing demand for memory and storage, challenging supply. And in the medium term, Micron can only meet 2/3 of the demand from several of their key customers. Very simple. Demand is massively exceeding supply. Micron says that 80% of their workforce is using AI, up 10 times from last year, and they're seeing tangible productivity gains and better financial outcomes as a result of AI. So here it is. It's not just a theory. It's not just a technology. It's leading to productivity increases and financial benefits for corporate America. That is super important as we head into 2026. Micron expects DRAM and NAND supplies to remain tight well into 2028. That's a long time. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.